Discuss the different financial reporting standards. The main one, of course, being the International Financial Reporting Standard. The other one is the US GAAP. So, if there is a company in the US, naturally it has to follow the US GAAP. Internationally, majority of the countries are following IFRS. Some countries have developed their own. And why we need to understand this, because if we are comparing a company like Apple with Samsung, and Samsung, let's say, is following IFRS, whereas Apple, let's say, is following US GAAP, then naturally we will need to make certain adjustments before we can compare these two. Now, the FASB, which is your Financial Accounting Standards Board, which issues US GAAP standards, and the International Accounting Standards Board, which issues the IFRS, are working towards convergence. But nevertheless, even now, there are significant differences between these two. And this Exhibit 6 from your curriculum presents some of these differences. GAAP being rules based, whereas IFRS being principle based. Now, rules based means it is more rigid, right? There's not much flexibility that the accountant has. It has to follow those exact rules. Principles based means that the high level principle is provided, but there is more possibility of judgment on part of the accountant based on context, right? So every situation is different, of course, and there is some room for judgment provided to the accountant under IFRS. US GAAP, on the other hand, is rules based and is much more rigid. And you will be able to understand this from the classification of interest paid on your cash flow statement. Now, as you might remember, we discussed that the cash flow statement has three sections: operating activities, investing activities, and financing activities, right? And we said that the operating activities is related to the business of the company, whatever sales is happening, whatever expenses are happening. Investing is related to buying and selling of long-term assets, and financing is related to getting money from providers of capital and giving money back to providers of capital. Now, you would think that payment of interest is giving money back to providers of capital, and therefore it should be in financing activities, and IFRS does allow you to put it in financing activities, but US GAAP says no. If you're repaying the loan, the principal amount of the loan, then you can put it in financing activities, but payment of interest is an operating thing, and it doesn't give you any room. It says it has to be in operating activities, whereas IFRS gives you some room that you can put it in financing activities or you can put it in your operating activities within your cash flow statement. So now hopefully you understand the difference between the rules based and the principle based approach. Now, inventory valuation, there is something known as first in, first out, which means whatever inventory came in first will be sold first. Or you can have last in, first out, which means the last one that came in first will be sold first. Or you can have a weighted average, that whatever is the average cost of inventory that has come in, whether it has come in first or last. So the ones that is being sold is going to be assumed that it is an average cost of the first and the last. Now, why is this important? Because in times of rising prices, naturally, if you will follow first in, first out, then the expensive inventory will be sold first. If you will do last in, first out, then the cheaper inventory, which was earlier received, the last one in, will be sold first. So here the profit margin will be higher, because if your cost will be low, sales price is same for both. But if you're selling the cheaper inventory first, you will be showing higher profits. If you will be selling the expensive inventory first, you will be showing the lower profits. And this obviously is going to impact your financial statement. So US GAAP allows first in, first out. It also allows last in, first out, and it also allows weighted average. But IFRS only allows first in, first out and weighted average. It does not allow under IFRS is LIFO. Development cost. And what is development cost? Think of research and development. Now, whenever you're coming up with new products, there is some research that needs to be done. And then there is the development of your product or service based on that research. Now, let's say this is my company. I have my assets and I have my liability and my equity. Now, if I started the company with 1 million equity, took a 1 million loan and got 2 million in assets, and let's say all of this is cash, and I start spending that cash in research and development, and all of this cash has been spent, then my liability still stands. My equity is first going to become zero once I spend the first million, and then it will actually become minus 1 million because my balance sheet has to match, right? So this way my financial position is going to be looking very terrible because I have gone in negative equity. The reason for this is because I spent all the money. But if I was spending that money to come up with some research and development, and I have, let's say, I have gotten a patent on some new type of medicine, now that, is it going to be considered an asset? Will I, instead of writing zero on my asset side, say I have an asset worth 2 million, and instead of writing negative equity, I could still say I still have equity worth 1 million, because even though I spent 2 million cash, but I developed a patent, and maybe it is worth more than 2 million, maybe it is worth 4 million. So then my equity will be actually worth 3. I would have created profit for myself by developing this new medicine. But the question is, does the financial reporting standard allow this? For you to spend some money on some kind of research and development and then yourself claim that, oh, I have created this asset. US GAAP is very, very, very strict that it does not allow this. You have to expense it out. It is going to be an expense. It will not be capitalized. It will not be converted into an asset. However, in IFRS, you can capitalize it. But under certain conditions. By the way, there is this possibility of capitalizing under US GAAP as well, but that is only limited to software. If you develop software, and that software also is developed not for your own use, but software developed for third party use, right? Then US GAAP allows you to actually record that as an asset. But only the hardcore development part where you paid software developers to develop this software. So there is little bit leniency in US GAAP for capitalization of software, but apart from that, everything is treated as an expense. IFRS is a little more lenient. There are ways to capitalize your development cost, but it is still not that easy to do. Anyways, more on that later. Now coming to your reversal of inventory write down. So let's say you bought some inventory for 10 million. Let's say you're a retailer like Walmart and you bought iPhone 14 inventory worth 10 million, and then Apple came up with iPhone 15, and then the value of your inventory went down because nobody wanted to buy iPhone 14 for the same price anymore because 15 came up, and you, let's say, write this down to 9 million on your books. You reduce the value of this asset on your books. Now, once you've reduced it, let's say Apple increases the price for iPhone 15 and the price in the market for iPhone 14 goes up as well, and you want to try and increase the value of this asset on your books again to 10 million. You cannot do it. Reversal of the write down is prohibited in US GAAP. However, in IFRS it is allowed. Again, if specific conditions are met, and what those specific conditions are, that if you reduced it to 9, you can increase it back to 10, but not more than 10. So it is allowed back to where it was initially, but not more than that. Okay, so you might be feeling that this is a relatively complicated area, and it is. And it is always changing. There are new standards coming up, there are changes happening in the guidance and principles of existing standards. So this is something that is rapidly evolving, and you need to keep up with it, especially if you are in a role where they directly impact your work. So the question is, how can you keep up with all this, right? How do you monitor developments in financial reporting and its implications for whatever work you are doing in the analysis and valuation of securities such as stocks and bonds? So the answer is that you have to focus on these three things, and we will talk about each of them separately. Number one is new products or transactions. Number two is actions of standard setters and groups that are representing users of financial statements. And number three is company disclosures regarding critical accounting policies and estimates. So let's discuss each one of these separately, starting with new products or types of transactions. Now, more and more new business models are being seen in the world, where you've got innovative developments in the area of fintech, and you've got cryptocurrencies and all this. So we as analysts should investigate that how are these products and services being reported for in your financial reports, right? And if there is any kind of window dressing going on, which is something you will learn more about later, which of course which is related to your assumptions that the management makes, the estimates that we talked about, right? The choice of accounting methods. So all of this is certain judgment that is given to the management, and we want to see how they are using their judgment. We can get in touch with the management and ask them that what they are doing and why they are doing it. What is the basis for their significant estimates that they have made? If they have used any judgment, then how did they come to the conclusion of that, right? And of course, why are we concerned? Because we need to know what is the implication of all of this on future cash flow. Because at the end of the day, the value of any asset is the present value of its future cash flow, right? And we need to understand what are the implications of all of these estimates and judgments for your future cash flows. Secondly, we can follow the standard setting bodies such as IASB and FASB on their website. There is a lot of material, and I believe this is probably the most important way to keep up to date with the changes in your standards. And it is very, very sort of related to analysts, because it is the financial analyst community that gives feedback to the standard setting bodies that how they can improve the standards. And of course, CFA Institute works closely with these standard setting bodies, both the IASB and the FASB. And we have volunteers that serve on these liaison committees that regularly interact with them and make recommendations to them. Now, finally, coming to the last part of this learning module, other sources of information, and we will be discussing all four of these separately. And the first one is related to information coming out from the company or the issuer. And why we call them the issuer is because they issue stocks and bonds. So that's why we refer to companies as issuers. And apart from their financial statements, they also give us more detail in their annual and quarterly reports and their proxy statements. Then we'll talk about third-party sources, which are public and proprietary both. And we also talk about proprietary primary research. So let's get into it one by one. Directly from the company, we've got earnings call, And there's analyst briefings that companies hold. I have attended some in my day, and so there are presentations that they share, investor days, press releases, management discussion and analysis, of course, part of your financial report. On your investor relations segment in your website, in company's website, they provide a lot of interesting data, so you can get a lot of information from a company's website. Public third party sources, think of the World Bank website, IMF, right? Other statistical platforms, your US Department of Labor, lot of US government websites tell you about retail sales, CPI numbers, macroeconomic data. General news outlets, Wall Street Journal, New York Times, Financial Times, right? Industry specific news outlets, or even your social media. There is even investor specific social media like stock tweets, etc. Proprietary third party sources, Bloomberg is a good example, or you can have industry specific like Rystad for the energy industry. So these are proprietary third party sources, and of course, you have your primary research companies, which are companies that sell this research that they conduct, and they could be doing surveys or any kind of comparisons. So you have these research companies that you can use. Let's summarize this learning module. First of all, we talked about the 6 steps of your framework of capital financial statement analysis, where first we define the purpose and context, which basically means what are the questions we are looking to answer and how much time and money we can spend on this task. Then we get the data, we process the data, we analyze the data, and we are able to then develop and communicate some conclusions to our clients. And then of course it is a iterative process that we keep reviewing what we have concluded. We talked about the difference between financial reporting and financial statement analysis. Financial reporting is the job of accountants and auditors, right? And we as analysts do financial statement analysis based on the financial statements that accountants and auditors produce. And what are those primary financial statements? Balance sheet, income statement, cash flow statement, statement of changes in owner's equity, and of course I told you there is a statement of comprehensive income, which you will learn about later, so which is related to your income statement, of course. So these are the primary statements that we talked about in detail, and supporting them are your footnotes, which give details about what were the estimates and assumptions and any kind of judgments that the management has made, what accounting methods they have used, and other details about acquisitions, disposals, any contingent or legal issues that might be there, or any pending stock options and other benefits that are given to employees, related party transactions, and so on and so forth. Then we talked about other sources of information such as management discussion and analysis and audit report, and we talked about 4 different type of situations, in which one is unqualified opinion, which is obviously the best. Then qualified is that there is some misstatement, adverse is that statements are not presented fairly, and of course auditors can also give you an opinion that they are unable to give an opinion, which is the worst situation. Then we moved on to talk about the differences in IFRS and US GAAP and how to keep up with these changes. And finally, we talked about other sources of information such as earnings calls, investor day, or I also said analyst briefings, and then all of this is coming from your companies. Apart from that, you could also have information coming from other public or private research companies and government institutions that provide us this economic information.